Hello and welcome back. Let's go across to another Big 80 Now exclusive. The SEBI board meeting is on March 28th and is likely to discuss amendments to the Insolvency and Bankruptcy Code. The market regulator is likely to call for a public consultation before finalizing the crucial amendment. Let's go across to Nayantara Rai for the exclusive detail. Nayantara Rai, what's on the agenda? What details do you have?
Hi, so the next SEBI board meet is actually on the 28th of March, and Insolvency and Bankruptcy Code is certainly the big theme in corporate India these days. It really shouldn't come as a surprise that you're going to hear that the market regulator is expected to discuss crucial amendments to the Insolvency and Bankruptcy Code. And this is after, it has sought comments, feedback from market participants, merchant bankers, etc. But nevertheless, sources do tell me that since these amendments are so important and have such a far-reaching impact, that the regulator may just decide to seek even more comments put up on the website. However, it seems as if the market regulator has shortlisted the various topics and the various amendments that need to be discussed for public discussion. So let me take you through some of the more important ones. For example, should there be trading restrictions for companies that have gone under the Insolvency and Bankruptcy Code? Here the industry, I think, is very deeply divided. You've had the likes of Sajjan Jindal of JSW being very vociferous about the fact that a lot of these companies are penny stocks, that any wild swings actually impacts valuations, etc. So you've had industrialists like Sajjan Jindal, for example, talking about the need to halt trading when it comes to such companies. On the other side, you've also heard market participants saying, no, that would be against the interest of the minority shareholders, that you need to have a proper price discovery mechanism, that this could add to transparency, and you need a very active secondary market. So this one is a very big item, and one that I understand the public will be thrown open for public discussion. It might even ask what are the kind of restrictions, because what sources do tell me is that SEBI does understand that some kind of restrictions might be needed because there are wild swings that are seen. It wants to prevent any case of maybe certain promoters having bad intentions, routing money, otherwise increasing their stake, etc. So there could be some restrictions that are certainly in the offing. The next big one is to do with minimum public float. Right now, the SEBI norms do insist that a promoter's stake has to be capped at 75%. It can't go over that. So what the market regulator is considering is that, if a new promoter wants to actually infuse equity into these insolvent and bankrupt companies, which may increase the new promoter's stake beyond 75%, there could be a relaxation. So in that case, you will see certain relaxation when it comes to the minimum public shareholding norm, where SEBI might decide it's okay for a promoter to infuse so much equity that it breaches a 75% level, and may then further introduce relaxation where the promoter would be given 2 years' time to bring it down to 25%. Right now, only 1 year is allowed. So that's going to be something else which is very interesting. The third one has to do with delisting. Right now, you have a proper delisting procedure, which also includes reverse book building. So what the market regulator is considering is considerable relaxation to this front, where you do away with the reverse book building altogether. And these are again representations that have been made. And instead, you leave it to the insolvency resolution professional, you leave it to the NCLT on how exactly should certain stocks be delisted. So as you can see, these are all, things that are being considered which will have a far-reaching impact. And that's why I'm saying it may be thrown open to the public. Also, higher disclosures. We have been hearing about how the market regulator wants many more disclosures to the stock exchanges in every aspect of the market, and the IBC will be no exception. So it may expand the scope of disclosures which have to be made, which could also include that even before moving the NCLT, before even the company is declared to be insolvent and bankrupt by the NCLT, such companies may have to start disclosing invoice copies, demand notices with respect to default. That's going to be a big one. I don't know how that is going to be taken by the public. But besides that, number of bids that are received, when the insolvency resolution professional approves a resolution plan, etc. That's, of course, to make this entire process far more transparent.
Right, but interestingly, Nayantara, it comes in along with high conglomerate battles for NCLT or IBC, different NCLT assets.
And that's what I found to be so interesting. So right now, the most contentious clause I think that you have in the Insolvency and Bankruptcy Code is Section 29A, which deals with related parties. Sources do tell me that SEBI is not going to be discussing that at this board meeting. It's not seeking public comments on that at this juncture. And maybe that's because it doesn't want to distort the playing field. The minute you do that and you introduce any changes to related party transactions, there could perhaps be a lot of parties that will move court. Related party transactions, for example, that's exactly what Ashwin earlier in the show was talking about. New metal. Should Revant Ruia, as a related party, being the son of the founder of SR Group, be a part of a consortium that's going to bid for SR Steel? Should ArcelorMittal, which has been a promoter entity in Uttam Galva at one point, be allowed to participate in the bidding for SR Steel? Should the Sajjan Jindal promoted JSW get to bag Monnet Ispat, which is promoted by Sajjan Jindal's brother-in-law? So this contentious Section 29A is not part of it. However, these are still far-reaching, important discussion points with far-reaching impact, because a lot of promoters may not want to keep these companies listed. They may need to infuse capital, which will increase their stake beyond what SEBI allows. So in fact, let's take this forward with Hetal Dalal of IIAS, as well as Sriram Subramaniam, the founder and MD at InGovern. Thank you so much for joining us here. Sriram, I'll come to you first. You think this is a step in the right direction? And I'm going to begin first with the trading restrictions. That's going to perhaps be the most controversial ones. You've had people like Sajjan Jindal demand it, saying it's very important. On the other side, a lot of market participants saying, no, it's important that such scripts continue to trade for there to be transparency, to find the true discovery price.
Our view is that the integrity of the capital markets should not be changed just to accommodate the IBC process. Okay, the basic tenets of the capital market should continue to exist. That is free trading and no restrictions on trading. Because at the end of the day, the IBC is a bankruptcy process, and there should be a price discovery mechanism for the shares. There are various hues of traders and investors who are participating in the capital market. And so,
Hetal, what is your stance on this? Do you need any kind of restrictions, even if it is not halting, but are there any kind of restrictions that maybe are required on this front?
No, that's what our view is. There shouldn't be any kind of restrictions. Otherwise, it is unnecessarily imposing or accommodating, I would say, bidders, accommodating these stressed companies, accommodating lenders, accommodating the IBC process, which is a process by itself and nothing to do with capital markets. There could be companies in IBC which are not listed on stock market, so let them take care. But the companies which are listed on stock market, why should there be any restrictions placed? I mean, they should allow the same free trading, and investors can take their own informed decisions. And at the end of the day, it is obviously the role of SEBI to ensure
that... Okay, I take your point. Sriram, I take your point. I want to invite Hetal Dalal also into this conversation. Hetal, that's Sriram Subramaniam, who believes that there should be no restrictions, no halting of trade of all the companies which are declared insolvent and bankrupt. What is your take on it? We have seen, certain suitors demand it, certain market participants saying no, that should not happen in the interest of minority shareholders. What is your stance, Hetal?
See, I have a slightly different view on this. I think when we look at some of these companies which are in the Insolvency and Bankruptcy Code, you have two large sets of investors. One is predominantly the lenders, and the second piece is retail investors. When you're looking at trading, and to be fair, a lot of them will be penny stocks given where the whole capital structure is. But given that you have a set of retail investors who will be invested in this, to have complete trading restrictions, I think may be a bit unfair. What I would think is that there needs to be significantly more or stronger monitoring with maybe tighter controls over potential volatility in the stock. I think that will allow, or that will at least arrest any potential price rigging or activities which will, sort of drive up or drive down the price dramatically. And it also therefore gives retail shareholders an exit option if they can find one. At the end of the day, through the IBC process, the promoters are going to change. The existing promoters are going to lose control. The new promoters are going to come in. And given that, shareholders should have an exit option. So I would say having a complete ban on trading may be a bit harsh, but certainly a far more monitored and controlled trading process is warranted.
Come in now, Sriram. These are very important points that Hetal is making, that perhaps, looking at the valuation of these stocks is not a bad idea to rein in volatility, to ensure there's no price rigging. There is no routing of money that is also being done for, increase of stake by the promoters. Do you find merit in that?
My point is precisely the same. So that means that just that the disclosure standards and those kind of surveillance mechanisms which we already hope exist with SEBI should be put in place, or should be already be in place, and the disclosure standards should not be relaxed for that matter. What Mr. Jindal is calling for, etc., is putting restrictions on trading, putting restrictions on who is going to buy, etc. Who cares? Even if the promoter is buying, the existing promoter is buying, as long as disclosure is there, let them go and buy. So what? Probably that's an opportunity for retail investors to exit. If the current existing promoters believe that there is value, I mean, they wouldn't have run.
Fair enough. I take that point. And when you're talking about retail shareholders, how could we not talk about the fact that new promoters may want to delist a lot of these companies? So, Hetal, what we are also being told is that the market regulator is likely to seek public opinion on whether they should do away with the reverse book building mechanism to delist all of these companies once a new promoter is on board. Where do you stand on that front? Is that advisable? Go with what the insolvency resolution professional suggests, what the NCLT accepts, and therefore do away with this market discovery price for delisting. Would you be in favor of that, Hetal?
So I think for these companies which are under IBC, a quick resolution is required, and the new promoter therefore needs to be given a certain degree of room to operate. Having said so, you can't also let go of the fact that there are minority investors invested in this particular stock. It's a listed stock, and therefore they need to be given a good quality exit as well. So one of the things that they may want to consider is to ensure that at least the minimum threshold for the valuation of is the same valuation at which the new promoter is getting into the company or buying its equity, with the base minimum that the minority shareholders will get. And over and above that, if they are able to provide a certain premium to that to minority shareholders to actually give in their stake quickly, I think that should be a good enough resolution. To start with a reverse book building process from zero, I think is also creating far more operational hazard for the entire process to get resolved. And I think, therefore, a path in between is really what one should try and achieve. So to that extent, like I said, minority shareholders should not get any less of a valuation. There should be equitable treatment of all shareholders, so shouldn't get less of a valuation. But, at a retail level, if they want to do an upside, I think that would always be a good idea to encourage the process to move faster.
Okay, I'm going to leave it at that since we're running out of time. This is the big ET Now exclusive, the various amendments that are being considered by the market regulator to give a fillip to the Insolvency Bankruptcy Code, make it more attractive, keeping in mind the interests of not just the new promoters, but also the minority shareholders. Thank you so much for joining us here on ET Now.